Alright, so just continuing off with the course, we covered this rally up. I'm looking on the right hand side where you see this rally up and then this down and up here. So what Wyckoff says about this is the market goes up, making higher highs, etc., and on increasing volume, and he says that that's a bullish indication. Alright, so let me just find that somewhere here. Yeah. The following 4 days in each of which we see higher tops, higher bottoms, and higher closing levels, accompanied by gradually increasing volume. So what is he talking about is from here you have 1, 2, 3, 4 days. So you see 1, 2, 3, 4, 5, whatever days. Gradually increasing volume, that's bullish. When that happens as the market is going down, as the volume is increasing, that's called liquidation. That's the term. When it's going up, he doesn't really give a term for it. He just calls it a bullish behavior. When he says higher highs, higher lows, higher closes, basically market is going up on gradually increasing volume, bullish behavior. However, when it goes up to the prior top, the volume expands suddenly much more. The rate of that volume increases. If you see the volume from bar to bar, it's gradually increasing, but when it comes over here, it increases significantly more. That warns him of a potential climax. Okay. And we're talking about climaxes on the swings, not on the trends that end the trend, not a buying and selling on that terminate the trend, but the minor climaxes that terminate swings. Alright, so this brings the market to the prior high. Volume surge after 4 days of almost perpendicular advance warns us of a buying climax. So he thinks that this bar right here, with that sharp sudden increase, is a potential buying climax. But here, in any case, we may expect hesitation. Why? Because there's a prior top there. Why? Because there's a lot of volume at that bar, and for sure there are trap longs there. So when the price goes back to that prior high, it is very likely that those longs will try to exit because they've been trapped as the market went lower. So this is their chance to get out even. Now observe that for the next 13 sessions, it is within a small range. Why? Because it is absorbing. Alright, now this is pretty important, right? Because this is also a springboard. The market is in this type of position where it's absorbing the prior high. It's the same thing as accumulation. It's meaning you have one side accumulating as the others are selling or breaking out, or not breaking out but getting out even. So try to explain that in the footnotes where he says the probability that this lateral movement, meaning that lateral absorption, right, is going sideways for 14 sessions, or trading range between this small area is absorption rather than distribution. How do you know? Well, there are certain factors. What is one of the factors? Volume remains low on the pullbacks, low on the reactions, low on the red bars. Here's a red bar. Look at the volume. It actually decreases from the prior interval. Here's a red bar. Look at the volume. Small. Let's see, here's a red bar, again, smaller than the prior interval. Just generally small. So the fact that the volume remains low on the reaction and tapers off promptly on the reaction to February 2nd. So low volume red bars, A. be from the tendency of the price movement into a narrow range instead of even reacting to the normal pullback of 50% is telling you that there's strength. Alright, which means stocks are not being pressed to the market. And finally, from the fact that after the recession to the February 2nd, volume tends to build up. After February, where the hell is second? I think it's over here. So now you have that build up. So after second, I think this is the second around here somewhere. Right? So this volume is building up, building up, building up, building up, building up. Alright? It's building up as it's making higher supports. Okay? From the tendency of the price movement to narrow range, and from the fact that after this recession, meaning after the pullback to February 2nd, volume tends to build up consistently. At the same time, there is lifting, meaning higher supports. Now here's the point. This behavior of volume gradually building up, meaning increasing as the price is making higher lows, and especially in a narrow range. What does that mean? That behavior is typical of two things. One, the completion of a period of accumulation, and two, absorption prior to markup. So that behavior, we're talking about narrow ranges, price higher lows, volume increasing, higher supports, right? It is telling you that the accumulation is finishing, meaning completed, or absorption also is completed. So what does that mean? If either accumulation or absorption of an area is completed, what happens? Markup. So you want to take a look at this footnote and go through factors 1, 2, and 3, because they help indicate that the market is going to skyrocket or enter the markup phase. And that's what you're trying to do. I mean, think about it. Like, if you're trying to trade springboards or whatever it is that you're trying to do, even when springs is up thrust, what you're really trying to do is get a piece. Piece of what? Markup or markdown. Directional traders, I mean, that's their goal. Get markup, markdown. They're not trying to really play ranges, right? What they're trying to do is get that markup. So anyway, after the markup of February 9th, we raised the stops to about a figure of the low trading zone. All he's saying is, alright, go to the low and put it like 1 point below. Right. We now have substantial advance followed by 6 days of lack of progress and comparatively high volume, which means the market has reached a critical position. So on February 14th, the market is over here, or somewhere around here. It's very hard to read this. Anyway, we now you have a big move up and 6 days lack of progress and comparatively high volume, which means the market has reached a critical position. But the average is immediately supported the next day on the 19th, closing nearly its top, or rallying away from a danger point. So here it goes down, red bar, right? And what happens? No follow through. Okay. So that's good. So this is a dangerous bar. Why? It's a big bar. It has increasing volume, right? Here, bang. And then what happens? No follow through. So it's rallying away because they're not ready to break. So what does it mean when you have lower volume? Yeah, if you have higher volume, it would mean like pressure's coming in. But if you have low volume, what else could it mean? Right? So when you see low volume, you say, I'm not really sure, it should be high volume, where's the buyers? But the flip side is, where are the sellers? So if you have that reversal here, he's saying that low volume under these conditions may mean that the supply of stocks has become scarce. So let's take a look at the 19th. 10, 11, 12, 13, 14, 15, 16. I think this is 19th. Anyway, so I think this is the bar he's talking about. So you have this bar up here, but the volume isn't that great. So if you have a bar like this, you want increasing volume because it's telling you the buyers are stepping in and they're going to break out above this high, right? That's the logical conclusion, or at least that's how we train to think. But for this behavior, he says that the lower volume under these conditions, meaning the market was able to rally away from a danger point, it's hugging that area, like flagging, right, may mean that the supply has become scarce. All right. So on the 20th, you got the pop. So next day on the 20th, the average gains goes to a new high, absorbing the overhanging supply on a volume increase of around 22.5 million to 4 million. 2.5 million to 4 million. It just means the volume increase. Why did it increase? This is the question. Why? Because the overhead supply at that area has been absorbed. It's just like a typically breakout. What you're doing is absorbing that resistance area. This case is significant because 2.5 to 4 is almost a double. So it would be like 1.75, let's just say. Say that this is about, let's say, 1.75 or 75% increase in volume. My math is not that great, and I don't want to think, but anyway. On the 21st, to a new high and a higher close with the volume up to 5 million shares. So, right there. That's not good. 5 million shares, thus making progress in proportions with the expansion of volume. On the 24th, it registers further gain of 2.78 points and on a volume of 5.3 million. That's 5.3. We now become very suspicious. Why has he become suspicious? Because on such high volume, and the failure to hold a quick upthrust. This term upthrust is different than what we're traditionally taught. This means it's just bang straight up. It's thrusting, meaning going with strength up. That's all it is. It's just going up, and it's thrusting, meaning strong, big bar, bang. Alright, now what happens is you have so much volume, and then what happens is you have an immediate bar right after that with a lower low, lower high, lower close that takes out the prior 2-day closes. Now, he says that's very bad. Why? Because all that volume to produce this bar, and the next day you get a lower high, lower low, lower close that takes out 2 prior closes. This is suspicious because this is how distribution, this is an attribute of distribution. Alright, to hold a quick upthrust to a new high on such heavy turnover, which is characteristic of distribution. Suspecting that the volume surge may be climactic. Climax are distribution. Combined climaxes are. Alright, because someone's taking that other side, and that's why you have high volume, so someone's selling as others are buying. Accordingly, we move our stop orders up to a point And what happens? All right. So again, he does some stuff because Saturday volume he like doubled it or something. Those days the markets were open on Saturday, but obviously there's less volume, so to make stuff kind of comparative, what he would do is double the volume, something like that. So what indicates here? Next day, February 25th, we observe a lower top, a lower bottom, and a lower close, as well as loss of 2 prior days gain. There you go. Which indicates that supply is overcoming demand and confirms our previous indications of possible reactions. If our stops have not been caught, we promptly close out our long trades and sell them short with stops 1 to 3. Again, look at this. He bought low in the climax and he's selling high on a climax. All he needs is this bar with a lower high, lower low, lower close. What's he doing? He's exiting. So when did Wyckoff trade short? The question is, when does he go short? The first indication of him going short is what? Is after the selling climax. After such, and here's your, here it is, and sell them short. Okay, so he's looking at the climaxes to go short. Why? Because CM went short. Why? Because CM did distribution. Why? Because he had a very nice new high. Market went climactic. After that, they had a red bar indicating what? That the prior bar was distribution, could not hold. What does Wyckoff do? Take that as an indication of weakness. What does he do? And distribution, so he sells. After such a prolonged rise, we may expect a substantial reaction than we have had in the December move, and perhaps an important decline, because there have been evidence of distribution extending as far back as February. So what's he saying? What are the evidence of distribution? Yeah, this bar is one evidence of distribution. Is there any other evidence of distribution? Yes, it's all the way back here with this high volume area. So distribution started here. What do we mean by distribution? Preliminary distribution. Like you have preliminary accumulation, this is preliminary distribution. That occurred here, and that was the first time he mentioned it, I think. And then the second time he mentioned it is over here. So he's saying that this is important. Why? Because it's not the first time that the CM distributed. This is at least the second time. So distribution started early February and then all the way into February, towards the end of February. So for that month, right? So there you go. Evidence of distribution extending far back as February 10th. On the 26th, the high-low close are almost identical with those of the previous day, and the market therefore is making no further progress upside on heavy volume, but the demand is still enough to hold it within the previous range. On the 27th, however, we note a lower top, lower high, lower close, but not very large shrinkage in volume to about 3.7 million. The significant feature of this day's action is pronounced change of market behavior. It's very important to identify this. The point here was high volume on a red bar. That's the point. The significant feature of this day's action is that it marks a pronounced change of market behavior. Change of behavior is something that he mentions. Here you go. Nowadays they might call it weakness. It is the first time since the uptrend the volume is very high on a reaction, meaning a red bar. Therefore, up to now, volume has been shrinking on the pullbacks. The fact that price cannot continue to advance into new high ground combined with a comparatively high volume leads us to conclude that the big fellows are unloading, and relatively large volume on the reaction of the 27th indicates they are filling up all the buyers on the way down from the highs with what they were unable to sell in the range. Alright, so here's an important point. You have high volume on the way up and high volume on the way down. What is that? That is a climax followed by a change of behavior. What does it mean? It means the CM sold on the way up on the climax, and then the CM sold on the way down on the change of behavior. Why is the volume high on the change of behavior? Because what he couldn't sell on the way up on the climax, he's selling on the way down. He's getting the best prices on the way up, and until no one's taking, and then getting the best prices on the way down, leading to high volume. All right. So the price cannot continue to advance into new high ground, etc., etc., etc. Other thing to mention is the price went straight up. Like this angle of ascent here is very acute. So price is going straight up. It's like almost hypodermic, right? It's like going straight up. Sell it. You get the best prices to sell. Sell it as price is going skyrocketing up, and then sell it on the way back down. So you have basically the same behavior down here where you have panic buying versus CM selling, and you have panic selling here with professional buying. So this is panic buying or FOMO buying with professional selling. I'm going to stop here and go over the rest. So up to now, I've covered up to here, right? And all the behaviors in here. So these behaviors you'll see all the time on any trend, especially daily on the SPY. You'll see this shit all the time. Yeah. All right.